Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go ahead and get to the economic data of the morning. The notes that I'm getting seem to then reaffirm that Goldilocks scenario, right? Because we have subdued inflation, everything else seems to be hanging in, the Fed can continue to cut. Maybe they can even cut 50 if inflation's come down enough. Ira Jersey is Bloomberg Intelligence chief U.S. interest rate strategist, and he joins us now. Ira, is that theory like, hey, it's Goldilocks, hey, inflation comes down, they can cut 50? Is that vibe with you?
It depends if the trend continues or if we stabilize here, right? One of the things, Alix, that I've been looking at is this trend in and slowing momentum in just the number of transactions. So one of the things that you get with the PCE report is not only these, okay, personal spending is up a little bit and inflation is a little bit lower, and yes, that seems like Goldilocks. But when you look at the momentum of the economy and the momentum of personal spending, it's come down quite dramatically, and it even slowed again this in the latest month, which is, it's still August, right? So it's still like pretty old data in terms of all before the cut and everything else by the Fed. So it does not point to an upbeat economy right now, and there is this issue, and I'm going to talking about like the potential longshoreman strike. If inflation goes up because goods sector prices continue to go up, I think one of the questions is, will consumers then buy more goods or buy the same goods at a higher price and not buy as many services? Because services is really what's been propping up the economy, and that was confirmed again in this report, with services continuing to be the one bright part of the economy, whereas everything else is actually kind of meh.
Now, one thing I've been trying to get a read on, does inflation data matter to the same extent that it did before, or is now the focus really shifting toward employment?
Yeah, so when you go back 18 months, the Fed basically had a single mandate, and that was to get inflation lower, and it didn't really, care what was going on in the jobs market. Or the jobs market was fine. So now we're more in balance, right? So yes, the inflation data still matters, but the employment data matters at least as much. And the employment data, is certainly weakening, but in a historical context, you go back a long time ago, and we used to say that like 150,000 jobs being created a month was fine. I think the issue is now is will that continue to decelerate further, and then what does that have a knock-on effect on wages? Because the other piece of the why spending continues to be reasonably robust in the services sector is that wage growth has been okay. So even though there's still a lot of people who are having a problem finding jobs, we talk about new entrants to the workforce, college students who can't find a job after school is trending a little bit higher. But the issue is that even though they have a problem, the people who have jobs have been continuing to get reasonable wage increases, and that's allowed for personal spending to be maintained, 2-ish% per year, and that's not a terrible outcome. The thing is, will that be maintained? And actually, I question whether or not it can be maintained, just given all of the trends that are currently in place.
What's also quite interesting, too, is the amount of money that people still have. And I hear you on the wage increases, but there was a revision in data yesterday that saw that income was actually revised up by about $800 billion between 2022 and 2023. I was also taking a look at money market funds and how much money has gone back into money market funds ever since the Fed did cut. And that if you take a look at, say, income generated from money markets surged to more than $27 billion in August alone. It's like we don't know how to discount that yet.
Well, there certainly is income from interest again, right? When we haven't been used to that the last 15 years, but you go back to the early 2000s, you go back to the 1990s, and interest income was a non-trivial share of overall income. You can't just look at money market funds, and the reason is that there's still this disconnect between the rates on money market funds, which are still well over 4%, right, on 4.75%, versus deposits at banks, right? Deposits at banks are still paying, relatively low interest compared to money market funds. So people are still still, incrementally, when incremental savings goes into money markets, as is still some deposit flight out of some banks and into money market funds. So don't think about that as cash on the sideline. I think that's a mistake. People are doing that. That is savings, right? That is people who are saving their money, and also people who are worried that, like with stocks at their relatively lofty valuations in some people's opinion, then the return to cash makes some sense, because if you can lock in 4% for the next, say, 3 to 6 months, and then redeploy that money, people are considering doing that, because you might say, oh, well, that's a little short-sighted too, because if money funds are paying 4.75%, and then the Federal Reserve were to cut interest rates another 100 basis points this year, then you're looking at where the 10-year yield is right now. So I do think that there are some people who are trying to reallocate, going into safe assets, but that rotation, that's not money that's going to rotate back into stocks just because interest rates are a little bit lower. It's going to find other fixed income assets or find its way back into bank deposits more than likely.
Let's talk soft and hard landings. What has been the general consensus as we've seen this latest data? What are you looking forward to?
Let's pretend that you can't use the word Goldilocks.
Yes, off limits.
So the way that we have. So the way we have it couched, and we put out a piece earlier this week where we looked at 5 different scenarios for how the economy might react, and where Treasury yields and how the Fed might react to each of those 5 scenarios. So one is a hard landing, and that's actually our base case scenario. Is we do think we're going to see a recession in the next 12 to 18 months. And because of that, you have Treasury yields much lower, the Federal Reserve cutting interest rates quite aggressively, even more aggressively than what's currently priced, which is already pretty aggressive, quite frankly. But then there is a chance for a reacceleration, right? So even though I think that there's going to be a recession next year, if I'm wrong, I might be wrong the other direction, which is we see a reacceleration in spending. We see firms not wanting to give up their employees because they're worried about retraining or finding people with the same skills easily if there is a rebound. And if we do have a reacceleration in the economy and inflation starts to tick up a little higher, then the Fed is going to have to stop very early, right? And that means that the whole entire Treasury market is going to have to sell off probably 25 to 50 basis points across the curve if that scenario plays out. So when you take like the weighted average of all of these scenarios equals a soft landing, but that seems like one of the least likely outcomes is that soft landing scenario. More likely we'll have either a hard landing or a reacceleration, but each of those seems more plausible to us.
Totally fair. Real quick before I let you go. But then we get all this inflow of stimulus from China. And does this kind of offset that impact? Does it blunt that?
Well, that's one of my concerns, and one of the reasons why you could potentially get a reacceleration with central banks globally easing rates, like not only China, right, but you have ECB and the BOE as well as the Federal Reserve all easing interest rates at the same time. You do have a global stimulus going that's going to be hitting the market. Now, it might take 3 to 6 months before we see any of that in the data, but it is coming at some point. And the Fed's going to cut in November, and they're probably going to cut in December. So that's going to feed into some next year's outlook for the economy for sure.
All right, Ira, thanks a lot. Really appreciate it. It's like the thing we've all been waiting for. We get it, and then it may not be so awesome on a broad level. Ira, thanks a lot. Ira Jersey, have a great weekend. Bloomberg Intelligence, U.S. interest rate strategist.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix here alongside Norah, Mulinda. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also tap the best of Bloomberg. And one of those things is this great Bloomberg News Morning Consult poll. It's a great poll, and it measures all the different aspects of the election. Now, in the latest poll of swing states, it shows that Vice President Harris now is leading among likely voters by 7 percentage points in Nevada, 5 points in Pennsylvania, 3 points in Arizona, Michigan, and Wisconsin, and 3 points in North Carolina. Both Trump and Harris are tied in Georgia. Joining us is Ira Davison, Bloomberg Politics Editor. Can you walk us through, I know I gave the broad strokes, but can you walk us through some of your takeaways from this poll?
Yeah, so Harris is leading in all of these swing states. So I'll note that those leads are within the margin of error. So what that tells us is that this race is really, really close. This is something that we have seen, across polling, other polls for several weeks now, and this is really going to be a nail biter of a race. And that either candidate really has the potential to win any of these states. And the Electoral College could come down to just one state. One of the ones that's being most closely watched right now is Pennsylvania. That's really a must-win for Harris, and it's the biggest Electoral College prize of all of these. When you kind of dig down into the data a little bit further, what is one of the key takeaways this month is that Harris is really cutting into Trump's lead on trust in the economy. We polled every month about how much people, whether they prefer Trump or Harris or Trump and Biden on a bunch of different topic issues. Trump throughout the entirety of this poll has had a lead on the economy, though Harris has really narrowed that gap. And that's really come as she started to lay out her policies on housing, on taxes, on prices and inflation. So this is sort of an indication that some of those messages are getting through to voters. The other main issue that voters say is their top issue this cycle is immigration. On that, Trump still holds a pretty big lead. So that's where you're going to see Harris focusing a lot of her attention, including today. She's headed to Arizona to go to the border. She'll, have a rally in Nevada later in the weekend. So you started to see her focus, she's tackled the economy. That's something that we'll still see as key to messaging, but now turning attention to immigration.
Now, since Kamala Harris announced her run for presidency back in July, has there been a specific shift at all in terms of her lead in the polls?
Yeah, we have seen her generally cut into to Trump's lead, both in national polls as well as swing state polls like this Bloomberg News Morning Consult poll. And on the issues, too, she has, inched up, specifically on the economy. She's grown her lead when it comes to abortion, housing, democracy. But the immigration is kind of that one key issue where she has not really made any dent in Trump's lead there. This is, sort of notable as, Trump has made a lot of inflammatory statements, including at the most recent debate about, this unfounded claim, I should note, about immigrants in Ohio eating household pets.
In terms of the issues, though, I'm wondering in terms of why do we think that she's gained more in the economy? How has she been able to close a little bit of that gap?
What we have seen from her campaign really over the past 4 or 5 weeks is they've been putting out different specific policies. So she put out a policy calling for an increase of building of housing units as well as this down payment assistance for first-time home buyers. You've seen her call for an expanded child tax credit. She's also called for other tax cuts, including one that Donald Trump has also embraced, no taxes on tips. She's called for an end to corporate price gouging and has sort of a fuzzy proposal there. We polled specifically on some of these policies, and they are broadly popular, talking, more upwards of 60, 70, and in some cases even 80%. So that means that she's winning over not just Democrats, but also a decent chunk of Republicans as well. And of course, independent voters. And those are the people that she needs to win over in order to win this election.
So for the average listener, how important are polls in an election year?
So polls are an important tool, but they, aren't necessarily, 100% predictive. They can give you a snapshot of where the race is right now. And obviously, as we know this year, that, a lot can happen in a couple weeks and really change the contours of this race. So, it's important to know that, this is sort of where the race is now. There is a margin of error. So it's important to not just look at, the headline numbers, but also, how much those have fluctuation within them.
Where does President Trump, former President Trump, still poll quite well? Like, what issues and how does that play out in the specific states?
Yeah, so he, really, immigration is one where he still has a strong lead. He also, still has a lead on the economy, albeit much smaller than he used to. Some of his proposals are also broadly popular. The most popular issue we polled this month was no taxes on Social Security benefits. This is one that he has, trotted out on the campaign trail. It's very appealing, of course, to older voters, but this is one that, has broad bipartisan support. He also has a proposal to end taxes on overtime pay, really very appealing to blue-collar workers. Some of his other proposals, however, things, like increased tariffs, He's also talked about increasing the state and local SALT deduction cap. That's something that he talked about in New York this past week. Those are less popular. More around 50% of people like those.
You mentioned Pennsylvania being the grand prize this year. How are the two candidates strategizing and trying to tackle that area?
So the airwaves there are blanketed in ads. When you look at ad spending from both campaigns, that is where they are putting, if not the majority, but at least the plurality of their money. So they're spending heavily in that state. You also see lots of visits there. Harris, very strategically chose Pittsburgh as where she was going to give her economic address earlier this week to talk about, bolstering the industrial economy and looking at steel and iron manufacturing. Trump, will see him go there next week. He's planning a rally in Butler, Pennsylvania, at the same site where the first assassination attempt was in July. You're seeing the candidates spend a lot of time there and spend a lot of their money, and that's really kind of where you see the bulk of the campaigning happening.
There has been a lot of criticism around Harris's campaign that she's light on details, and I appreciate that she did give that speech, as you referenced, in Pittsburgh, but nonetheless, in your poll finding, is that still a problem?
So it shows that she we actually asked a specific question of, which candidate is described as having the best detailed policy positions. In August, she was trailing Trump, and then in September, she's leading him. It was sort of they were pretty close, and relatively close, but she has pulled ahead. And part of that is she has given more economic speeches, and she also put out a document this week. This was, however, after the poll was, but she put out a big 80-page document that had some more policy details. It was still largely a political document, but she put some stuff on paper. These are the kinds of things her campaign sees as helping. Trump has done less in terms of writing out his ideas, but he's been sort of trotting out ideas week by week.
All right, Laura, really appreciate it. Thank you so much. Laura Davison, Bloomberg Politics reporter on the latest Bloomberg Morning Consult poll.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, taking a look at these markets here. Yes, it feels like we continue to kind of melt up / move higher. And I say that because clearly we've not seen a ton of volume. Doesn't feel like there's a ton of conviction, but yet we keep making record highs after record highs. The wild card, though, is what's happening with China, and sort of what I'm interested in is where the catch-up potential is. Quants were caught really offside by the move, right? Flows are going to be caught really offside. CTAs will be caught offside. So how do you manage all of that? Nadia Lovell is Senior U.S. Equity Strategist at Global Wealth Management over at UBS. How are you looking at the stream of money that's going to be pumped into the Chinese economy?
It remains to be seen how that actually translates into real demand and the real economy. It's not like the code coming out of COVID when the COVID zero policy was turned off. We sort of flipped a switch and that helped to reopen the economy. It's going to take some time for this to filter through to the economy, just given the issues in the property market over the last couple of years. Yes, you're seeing those China exposed stocks catch a bid this week, but I think that some of this remains to be seen and how that actually translates into profits.
And on a domestic landscape, that data that we got this morning, the inflation data that everyone's looking at, some people are saying that we hit a sweet spot. Others are saying that this, is just a small thing in the pipeline. What do you think the impact of this data that we saw this morning will have moving forward?
I think the focus right now is more on the growth data than necessarily the inflation data. The inflation data recently has been well behaved. It came in line with our expectation, core PCE at 2.7%. So I don't think that was any real surprise to anyone. I mean, monetary policy have started to ease. It took inflation to get us to that, and it will take the labor market to determine how large those rate cuts are going forward. So even though the Fed has said it's data dependent, the data is more focused on the labor market and less so on the inflation at this point.
So what kind of sectors do you like right now?
We continue to like tech, just given the AI tailwinds that are behind tech. We've gotten a number of incrementally positive news this week when you look at, the likes of Accenture that points to continued demand for generative AI and investments around there. And also even Micron earnings this week that suggests that high bandwidth memory chips are sold out for 2024 and into 2025. So we like that story. We also would lean into financials as cyclical value that should benefit from lower interest rates and a potential pickup in loan growth. And then I think you balance that out with some utilities. That this is no longer like your grandparents' utilities. Yes, it's defensive, but it also has those secular tailwinds behind it, given the increase in demand for power associated with AI.
Nadia, what about small and mid-cap stocks? What's your view there?
Yeah, mid-cap is actually at a record today also.
Yeah.
Mm-hmm.
Yeah, so we are neutral on small cap. And so that means you should have a market weighted exposure to small cap. I think that small cap will benefit as interest rates come down from a balance sheet standpoint, some alleviation of pressure. But what we're really waiting for to become more constructive on the space is a pickup in earnings growth, which just hasn't been followed through yet. I mean, that could come through if we start to see a pickup in PMIs. I mean, PMIs manufacturing has been struggling for quite some time. So if we get that, then maybe we could be more incrementally positive on small cap, and we see that acceleration in earnings growth potentially in 2025.
Well, what about mid caps? Because it feels like that some say that could be the sweet spot, right? Like you're not ready to get into small caps, but mid caps could provide that for you.
Absolutely. I mean, mid cap then tends to be a bit higher quality. So we would also look at that area as well to be able to add to. But our preference overall is really more towards the larger names that we think that do have those secular growth stories. But I think mid cap is also, you can find some value there as well, because you are right. It is in that somewhat of a sweet spot.
All right. Thanks so much, Nadia. Really appreciate it. Nadia Lovell, Senior U.S. Equity Strategist at Global Wealth Management over at UBS. We really appreciate it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Going to the markets here, some of the headlines is that Intel rebuffed an offer from ARM after ARM inquired about buying a unit from Intel. Mandeep Singh, senior tech industry analyst, joins us now for Bloomberg Intelligence. Mandeep, is this just going to be like a string of random suitors for random parts of the business here? Like, what was your take on this?
I mean, in this case, it's very specific in the sense that Qualcomm was more about chip design. ARM is specifically interested in the IP related to the instruction set business that Intel has. Remember, Intel has got a lot of assets within the company, which is, patented. It's IP that's very desirable. That's been the basis of their moat for the last 40 years. And ARM is a competitor to Intel's x86 architecture, but at the same time, ARM wants to expand into other adjacencies. And that's where, they are looking probably to buy some of that IP or patents from Intel. I mean, we don't know the details. That's just a speculation, but I can't imagine ARM getting into, chip design or foundry manufacturing. That's just way out of what they're doing right now. So the natural extension of their business would be to buy some of the IP from Intel.
I mean, the company's got quite a few suitors. We're seeing shares down as much as 52% year to date. What do you think would really be a positive outcome for the stock? What are analysts saying the route that they should be taking?
I mean, everyone looks at Intel based on the sum of the parts basis, and clearly the current market cap of Intel doesn't justify, all the assets and the IP that is within the company. At the same time, they're bleeding money when it comes to the foundry side of the business, losing almost $7 to $8 billion a year. They're investing a lot in CapEx, subsidized by the U.S. government. But the turnaround clearly hasn't played out. And that's where, the bigger you are, the harder it is to turn around the ship. But at the same time, one could argue, that x86 business will rebound if this AI super cycle has to play out, because they still have that dominant 80% share when it comes to the PC market. And if everyone is upgrading their PCs, guess what? It will be an Intel PC. It's not as if they are losing market share on that PC side. So that's the hope when it comes to the Intel turnaround.
So do we know when the PC market, the consumer market, is going to start turning around? Like it feels like the trough is in, but how long that looks and what that looks like?
I mean, we just have to watch for data points. In fact, Micron this week gave us one data point. They called out AI PC being, rebounding, and 2025 being a better year than the past couple of years. So clearly that inventory correction has happened, and we have seen a trough. And now it's a question of how fast does the units recover. And I think that's where Intel will see a nice rebound on that client PC side. On the server side, I mean, clearly there is no fix right now. They are losing share to NVIDIA and AMD, and that's unlikely to change in the near term.
Hey, Mandeep, with about a minute on the clock, I'm curious, what will investors really be looking for from earnings? What's the most important thing here?
Well, I think they're looking for a plan. So Amazon, tying up with Intel to use their foundry side for chip manufacturing, that's a positive sign. The question is the scale at which Amazon is going to look to use Intel versus TSMC that they're using right now. So that foundry business is where Intel is bleeding money. Hyperscalers partnering with Intel on that side is great news, and I think that's where you want, more positive news in terms of Microsoft and other hyperscalers really ramping up on Intel Foundry.
All right, Mandeep, thanks a lot. We really appreciate Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, joining us on Intel and the struggles and kind of how he wind up moving forward from there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So let's get more into it. Michele Martin is president of Prosperity. It is an EisnerAmper Company, to discuss her market outlook. She joins us now from Minneapolis. Hey, Michele, I feel like some takeaway from the last 2 weeks has been, are we actually in a global easing cycle now that China's on board? And does that change how you think about things?
It certainly does. And thanks for having me on today. I think with the global easing, there's more likelihood that we might be heading for a soft landing. We're seeing it across, what's happening with China today or this week. And we're certainly, with interest rates coming down, it appears that we're in a really good place. It's been a great week for that, and the trends are showing that there may be more cuts ahead.
And when we're thinking about China just as a has a big economy, how much do we really think that this will affect other aspects more globally, and pointing it back to the U.S. here?
So it's interesting, and I think you were just talking about this. We've been on the sidelines as it relates to China, as many have, just based upon the performance. I think we would typically have a wait and see attitude. Again, understanding what comes out of the election and what tariffs might be in place. I think that we've seen a general trend of companies moving away from China. So I would say that we have looked at getting back into emerging markets, particularly with this news with China, and we would ease our way back in.
How do you do that? Like, is it local consumer-facing stocks? Is it through ETFs?
It's through generally ETFs and mutual funds within our portfolios, absolutely.
And how aggressive? You said dipping your toe. So how does that progress work? Like, you dip your toe, and then what? Do you wait to see if more stimulus comes? Do you wait to see how assets perform?
Yes, exactly. What we're really look at, Norah, is for the trends to take hold. So in other words, it would be a dipping the toe in, probably a position of a couple percent in a portfolio, and then really watching what that performance looks like, what the volatility is, and if we're starting to see the trend become solid, more than an indication. It's relatively recent. So we would want to, and from an emerging markets perspective in our portfolios, that generally is a relatively low allocation for us to begin with.
Can you just speak a bit more to the opportunity in emerging markets more broadly?
Well, I think the thing that's really interesting about emerging markets, being a part of.
Looks like we're freezing up a little bit. Let's see if we can reestablish that connection with Michele Martin, president of Prosperity. We're just going to reestablish that connection and see if that winds up making sense. Okay, but what you were asking about was flows, right? And sort of really diversifying out?
Right. I mean, I think that's really interesting, especially as we've really been looking at the China stimulus and how it's really been affecting. I mean, we just had Abigail Doolittle here talking about how it's even affecting casino stocks. Mm-hmm. So I'm really curious how she and other investors are really thinking about how they're going to be allocating their money money and if they want to put some of it into emerging markets as we're looking forward.
I've been talking to a tactical strategist at one of the main banks, and just how it's been a really painful week for some of the investors, and that flows are now flying into stuff that we haven't seen before, and that's been a really painful week. And take a look at tech and the underperformance that we've seen, right? Like Micron was a one-off,
right?
This week, but if tech continues to kind of underperform,
what does that mean?
What does that mean? Like,
what does that mean?
And then on a headline level, can the headline S&P go up if tech is underperforming? It may be, but even so, is it just churn kind of under the surface?
Right, and it's accounted for so much of our gains this year. It's really had the wind in the sails here.
Yeah, exactly. So definitely looking forward to that. All right, I think she's back. Michele Martin, President of Prosperity, joining us. Sorry about that glitch, Michele. So you were saying in terms of flows and where it's all going, walk us through it.
So I think, generally, from a flow perspective, I think where we're really watching things is we've had really strong success with high yield credit. But in the equity market, we're really looking at the trends that are starting to take hold. And what we're seeing particularly over the last quarter is that we're seeing dividend paying stocks, value stocks in sectors like utilities and industrials really start to take hold and outperform, and perhaps become more of a position within our portfolios. Technology has been such a strong performer, and what we're seeing now is that technology is basically consolidating. It's come so far so fast, and we're starting to see those trends start to change. That also gives us an indication that we might want to be looking at Europe a little bit more. We've been waiting for Europe for that trend to solidify. We have underweight in our international stocks in general, both in developed international as well as emerging markets. And so this is actually starting to look much more attractive in those sectors as well.
Now, Michele, how are you all thinking about small and mid caps? Is there a play there?
Well, there is, and we've definitely had a presence in the mid cap space, holding back on small cap. But with interest rate cuts, there's definitely an opportunity because particularly small businesses have much more sensitivity to interest rates. So with the cost of credit going down, there's absolutely an opportunity that we could see a rebound in small cap.
And I say if because it's like I've heard this story before, right? I've heard the story about European cyclicals. I've heard the story about small caps before, and they always seem to manage that story for like a few weeks, and then all of a sudden we're back to the basics, right? So this is the question.
That's right.
What conviction do you have that this time might be different?
Well, I think we're seeing it in the results. We're seeing some quarterly numbers that are starting to point towards that. We saw small cap rally earlier this summer, and then we had a big pullback in it. So, as I had mentioned earlier, it really is important to start to see those trends take hold, to start to see the consumer confidence with small business owners. I think that plays into it as well. And to have banks be a little bit more agreeable to lending. We're seeing credit standards being relatively tight right now. So I think that conviction is probably still a little ways out from our perspective on small cap. So we're kind of waiting on the sidelines, ready to jump in. But the environment is definitely more favorable than it has been.
How are you thinking about opportunity in the equities market? Especially, we've been hearing people saying that we could be at lofty levels. How are you looking at that as we think about year end and all the rate cuts that people are pricing in?
It's so true. I think, and we actually have been slightly underweight to equities just because of where we're at. Equities are somewhat priced for perfection, particularly on the growth side of the equation. So I think it's stay steady, invest for the long term. I think what we're really looking at and what we're seeing with a lot of client accounts or people that we're talking to is that money markets have been so favorable. And so they've pulled out of the markets thinking that they're overextended. I think that it's definitely, methodical, a phase in. I think the challenge is that if you wait on the sidelines too long, you kind of miss.
Mm-hmm.
If we look back even to the years of after the Great Recession in 2010, 2011, I had many clients that were just afraid to get back in and sat on the sidelines and really missed that opportunity. So I think it's a gradual phase back in for those that are sitting on the sidelines. And then it's really being thoughtful about tactical shifts within the equity exposure to these areas that, are showing some opportunity.
All right, Michele.
Most people...
Yeah.
Yep.
Michele, we got to leave it there. We're up against a break, but it's such a good point, and also sort of when we're going to wind up seeing that money come out of high yield savings account and money market funds. Michele Martin, president of Prosperity, if you're still getting 4%, it's still 4%.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The news over the last 12 hours was Hurricane Helene, right? Helene has just barreled into the western coast of Florida. Dangerous winds, knocking out power for more than 1 million customers and threatening to unleash deadly flooding across several states. Helene made landfall near Perry with top sustained winds of 140 miles per hour, and that's according to the U.S. National Hurricane Center. It made it a Category 4 on the 5-step scale before weakening now to a tropical storm. And these headlines just keep on coming fast and furious. We wanted to take a business angle to it and look at the oil and gas industry. Vincent Piazza, Bloomberg Intelligence Senior Equity Research Analyst for oil and gas. Vincent, to some extent, these companies are very well known to these risks. They know how to shut down the infrastructure. They know how to shut down any sort of offshore rigs, etc. What have they done in the path to the storm?
Yeah, you're right. The companies, the infrastructure benefited from, probably not the best word to say, but the storm moved eastward, so it was not a direct hit on the installations. And in fact, some of the operators are looking to restart the platforms. I know Chevron mentioned earlier that they'll be looking to bring production back on the 6 platforms that they shut in. It's never really about the supply side, because as you mentioned, Alix, the companies are well versed in executing these types of disaster plans. Where the impact really is on the demand side. And especially for guys like me who cover natural gas, those without power, that can be a longer term issue across many states. And the latest stats that we have, we're looking at least roughly 4 million people without power at the moment across states like Florida, somewhere around 1 million, Georgia, somewhere around 1 million. And I think if you add the Carolinas together, that's somewhere around 2 million. So there's as much as 4 million residents without power. And that is truly devastating. Although if this had occurred in July and August, where the weather would have been much warmer, it would have a more devastating impact. We're right in the middle of shoulder season here, so maybe there's a little bit of reprieve with the weather, but over the next 6 to 10 days, our weather projections, what we see from across the various providers is that it is somewhat still warm in that neck of the woods, but probably not as bad as it would have been if it had hit during July and August.
Yeah, you mentioned the idea of a demand. Just how catastrophic could a backup in demand be for oil and gas companies here?
Well, if we look at the last couple of days, you're roughly looking at 2 BCF a day of demand coming off. And power gen is a very important end market for many of these producers. It's the supply into the electricity facilities, and that is a significant source of consumption for natural gas. So it is a very important market. It is interrelated because when a storm like this hits, thousands of customers come offline. And of course, these customers not only use these facilities for air conditioning, but also hospitals and also other areas, other institutions need these facilities as well, the HVAC facilities, especially in the South, where it can get very, very warm. And that's where this storm is hit. If we're right, 4 million folks without power, that takes a long time to bring back online, especially now.
Yeah, absolutely. And at the flip side, just before we let you go, have about a minute left. I'm taking a look at crude here, WTI at 68, right? It doesn't sound so bad, but I look at that curve. We are still in backwardation, but the re-rating we've seen in the whole curve at that front end has been quite extreme. At what point do producers get worried?
So producers are pretty much still in a little bit of a sweet spot here. That 70 handle is still okay. The demand side of the equation for global crude, that tends to be the real concern. What happens overseas, especially in China, that still seems to be somewhat of concern. Demand overall, especially here in the U.S. as well, as things tend to slow. But for the most part, the producers are holding in discipline very, very well. We as analysts and investors are more concerned with that discipline and returning excess cash to investors, either in the form of dividends or share buybacks. So the operators have been hearing that message and have been sustaining that discipline overall.
All right, Vince, really appreciate it. Thank you so much, Vincent Piazza, joining us. Bloomberg Intelligence Senior Equity Research Analyst, Oil and Gas, joining us on the impact of the storm Helene that has wreaked havoc there on Florida as well.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.